Welcome to Barchart's educational webinar series. Today we're going to be focusing on the 101 value investing style of one of the most successful investors of all time, Warren Buffett. By the end of the session, you'll have a deeper understanding of the key principles and strategies that have made Warren Buffett a household name. To help you get the most out of this webinar, we'll be incorporating Barchart's features that'll assist you in finding the most popular values, metrics values, and these features will provide you with an analysis to help make a more informed investment decision. Hello, everyone. My name is John Rowland, Barchart's head of trading education, and today's session will be covering topics such as understanding the margin of safety principle, finding undervalued companies with strong fundamentals, using Barchart Stock Screener to identify potential investments, and analyzing financial metrics to assess a company's health. Now, by incorporating Barchart's features, you'll have access to tools that will help you start investing like Warren Buffett. Now, before we get to that, please welcome my partner and our moderator, Barchart's project director, Jean Baker. Hello, Jean.
Hi, John. How are you?
I am doing great. How are you doing today?
On this blustery day in Chicago,
The Windy City, huh?
It's a windy city today, that's for sure. Yeah, doing well. We're very busy here at Barchart. Very busy. working on a lot of enhancements for everybody out there. So
well, I'm excited about those enhancements, and so I'm always looking forward to seeing the new things that we're going to bring onto the website. So maybe we'll get an opportunity sometime in the future to talk about a lot of those new features.
Yeah. Okay, well, I think we're ready to get started, right?
Yeah, I think so. Let's go.
Okay, let's go.
All right, just remember today's session is for educational purposes only, and that decisions to buy, sell, or hold or trade securities, commodities, or other investments involves a risk and best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any losses or damages that you or anyone incurs as a result of any trading or investment activity that you or anyone else engages in based on the information or material you receive through barchart.com and our services. So, what is value, or what is a fair price? We're going to look at Warren Buffett's investing philosophies and attach some common metrics or ratios to them. But make no mistake about value. It's subjective. And the fair value, or as Buffett calls it, fair price of an asset is purely psychological. A stock is only worth what somebody else is willing to pay for it. Though the worth of any company is a function of its growth prospects. A company that grows for 5 years, in 5 years' time, its price will ultimately be higher. Buffett suggests that investors should focus on identifying companies that are currently not being accurately valued by the market. So how does he determine that? Well, his first tenet of philosophy is buy wonderful companies. Now, Buffett defines these companies as those companies that sell a product or provide a service that people need. And is that product or service unique? Does that company have brand loyalty? Think about Buffett. He says he drinks like 10 Cokes a day, and Coca-Cola is one of those companies that he invests in. The other one is that you always see him talking about is Seed Candies. But does that company have a niche, or does it have a competitive advantage? Now, according to Buffett, the first value metrics that he looks at is to find companies with profits that far outweigh its interest payments. Now, later on, I'm going to show you a slide that explains the ideal behind Buffett's calculation of something called the intrinsic value or fair value. But until then, let's stay on course. And so his second tenet is stay in your circle of competence. Now, what is your inherent in your life? Where do you live? What is your own field of expertise? For instance, for me, my background is in the energy field. So I have a lot more energy stocks usually in my portfolio, sometimes more than I probably should. But Peter Lynch of Fidelity Magellan refers to this as trade what you know, profit from what you see. What companies are you loyal to at home and office? And it's a simple concept. But can you tell the story about why you believe this company that you're going to choose has value in 2 minutes or less? And would a fifth grader be able to understand your story? Third tenet, evaluate companies first. Don't look at the price. Here's where some of our value metrics is rubber hits the road. So to name a few, profit margins, return on equity, and debt to equity. Now, Buffett tells us to buy businesses, not stocks. Now, companies that are consistently growing sales, either by increasing customer base, developing new products, and have the ability to raise prices of their brand names. Invest with a margin of safety. High return on capital for long periods is a productive asset. Now, Buffett is telling us a couple things here. First, the metrics is like low PE ratios, consistent earnings per share, and growing dividends. But also Buffett in this wording of long period. In other words, what he's saying to us is that value investing, is about patience and time. Now, Buffett says that the stock market is a device for transferring money from the impatient to the patient. And in his calculations of intrinsic value, he uses a 10-year timeline horizon. Play big and don't waste opportunities. Now, one of his most famous quotes is that he attempts to be fearful when others are greedy, or to be greedy when others are fearful. That kind of contrarian aspect. But though Warren also goes on to talk about having, let's say, a punch card of 20 numbers, and that every time you purchase a stock, you punch a hole. In other words, you're limiting yourself to the trading, puts priority on choosing really good choices. Now, Peter Lynch says that the potential time to buy a stock or stocks is about once or twice a year. So if you put these two thoughts together, you get a portfolio of 20 stocks in 10 years. Now, I think it was believed there was Ansel Adams, the famous photographer, who said that the time to take a picture is when you see it. And Buffett would follow up with, make good choices, bet big. So what do all these quotes say to us as an average investor? Well, wait patiently for the moments, do your homework, and when values and timing line up, be decisive. If you're going to make good choices, then time is on your side. And then finally, invest in yourself. Continuing to seek knowledge and education are what Buffett believes is the best investments. Now, being part of our webinars or consuming Barchart content, believe it or not, is an investment. And myself, even after 4 decades of being in the business, I recently took and passed the CMT designate program. So improving myself even after 40 years. So with those tenets in mind, let's move to the metrics of valuation, remembering that value is what means to you and you determine how much you're willing to pay. With that being said, though, I will offer some kind of general guidelines and consensuses of what value is. But in essence, many of these valuations are used as comparatives. So different sectors or industries will have different comparative valuations. And even at a granular level, let's say between two different stocks. So the top 10 metrics values in no particular order. First one is price to earnings. Now, a fairly priced stock has a PE ratio that is about equal to the expected annual growth rate over, let's say, the next 3 to 5 years. Now, another way we can look at PE ratio, or a thought process of the PE ratio, is that it's the number of years it would take the company to earn back the amount of your initial investment, assuming the company's earnings stay constant. In other words, zero growth. So this is kind of that margin of safety that Buffett was saying. Now, the guideline in the modern era is that a PE ratio between, let's say, or below between, let's say, 20 and 25 would represent value, or could be a slow growth mature company, or it could potentially be an undervalued stock. Above 25, then you are looking probably at a high growth company or maybe a young company. A price to book ratio. Now, this is another measurement or margin of safety metric favored by analysts to judge value. In stocks selling, let's say, higher than 3 book value, price to book, typically are growth stocks that have little book value. And stocks trading below book value could represent stocks that might be undervalued and have potential price appreciation. A debt to equity, it's just total liabilities divided by total shareholders' equity. Now think of this as a measurement of leverage of borrowed money that helps to enhance the return on owner's equity. So in other words, can the company grow organically within itself, or does it require outside funding? Now, the rule of thumb on debt to equity is that 1 or below is good. In other words, less debt, more equity. Dividend yield, another margin of safety metrics. Healthy companies pay dividends. Growing companies increase dividends. There is a correlation between high earnings and related to higher dividends. Now realize that half of the returns of the S&P come from dividends, and that compounding effect of dividend reinvestment has a profound effect on a portfolio. Earnings per share, the portion of a company's profit that is allotted to cash per the outstanding shares of common stock. Now, earnings per share is calculated based on after paying taxes, preferred shareholders, bondholders. Now, there's no real guideline here, but when we look at Buffett's portfolio in a moment, we might discover a comparative value. Free cash flow. Now, this is the amount of money or cash the company has after it pays its expenses, its service its debt, its capital expenditures, and paying out its dividends. Again, this is going to be more of a comparative value, but the higher the free cash flow, the stronger the company's balance sheet is. Return on equity is calculated by dividing the common stock's equity, or its net worth, into the net income. Now, the value kind of tells us the effectiveness of the company's money being used. In other words, how efficient they are. Again, this is more of a comparative measure of valuation. Price to sales. Price to sales is the per share sales. Now, analysts use this ratio to determine whether a stock current price is rich or cheap. Now, analysts do believe that stocks with low price to share values will outperform those with low price to book, free cash flow, and even low PE ratio. So the guideline on this one is somewhere between 1 to 2. Enterprise value. Oops, there it is. Enterprise value. Now, this is a more effective measurement of a company's total value than, let's say, using market capitalization. So simply stated, this is like how much it would cost you to purchase that company. And some analysts will use the enterprise value divided by the earnings before interest and taxes to value companies. And then operating margins, which for us on our site, we're talking about net profit margins. The measured amount of how much profits are earned from net sales less the cost of the goods, including general and administrative expenses. Now, this helps us determine the operating efficiency of a company and their pricing power strategies of the particular company. In other words, how much profit you get for every unit of sales. So all of these can be used in terms of metrics to help us analyze a company's financial performance. And if we look at them, and we can help us determine if a company might be undervalued. But it's important for us to note that value investing is not just about numbers, right? It's about the story the company is telling, that uniqueness of that company, the management of the company, and the future prospects of that company. Okay. So let's apply some of these newfound knowledges and compare these values and ratios to Warren Buffett's portfolio. And so I've gone to investing on our website, and you can see over here on the left-hand side, it says Warren Buffett stocks. And that's what I've done. I pulled up the Warren Buffett portfolio. And so these are all the stocks that are in his portfolio. So let's go back here to our main view, and I can sort these by A to Z, or in this case V to A. And under the main view here, we can open this up and we can go to fundamental view, some of those fundamental values that we just talked about. And again, here's our market capitalization, but here's PE ratio. And so I can sort by the PE ratio. And I'll just click on that, and I'll go from highest to lowest. So remember, a fairly valued PE ratio is that expected growth over the next 3 to 5 years. And notice that in Warren Buffett's portfolio, how many stocks are below that 25 to 20 level. Earnings per share. We said that there's no real guideline on this, but we could maybe use this as a comparative. So again, if I sort from high to low and I eliminate these outliers that have maybe a super high earnings per share, that we get an earnings per share value, looks like around, somewhere just a little bit above 10 to, the bottom end about, 3 to 4. Remember, how much growth do we want to see for the next 3 to 5 years to pay for our PE ratio, right? So that would be a good way to do that evaluation. For instance, here, earnings per share of, $8, right? That would be a good earnings per share for a company that has a PE ratio of 15. So again, if we look at the kind of the mean value here, I think, in terms of what Buffett is looking for, and again, some of these companies, we have to be understand that, he bought them at a lower valuation and they appreciate it. But I think we can get a general idea here. It looks like that we want to be above, let's say, $4 to $5 earnings per share. Now, beta is not a true fundamental value. It's more of a technical of value, but beta basically tells us how much a stock will move in a relationship to the S&P. But I think this is a good tool for us in terms of looking at Warren Buffett's portfolio. And you can see that, we don't see a lot of super high beta stocks. In other words, stocks that are very volatile. Matter of fact, you see a lot of stocks that fall below the value of one being the S&P. Now, I think there's another point here when we talk about Buffett's portfolio and the fact that you can see right here in the middle of his portfolio, he has invested in the S&P Spider and the Vanguard Value, right? So this brings us to kind of an interesting point. I think this is another philosophy that Buffett will tell us, and that he says that index funds are the best way for investors to gain exposure to the stock market. Why? Well, because they have low fees, and then he giggles or laughs. You'll hear him when he talks about this. He says, and I don't need to be concerned about expert, quote unquote, analysis. But there is some truth to this statement. Burton Melke, in his book that he wrote in the 1970s called A Random Walk Down Wall Street, said that investors were better off putting their money in passive managed index funds. Now, that doesn't sound like fun, but I believe in Buffett here, the purpose is about benchmarking and diversification. And I think the lesson here for us is that we can choose a few stocks. Remember our 20 punch card, right? But if we're going to diversify our portfolio, you probably want to look at some of these indexed ETFs. Dividends, right? That compounding effect. Now, not all companies pay dividends, but over half of Warren Buffett's companies do. So what I did is I want to go to custom views. And if you don't know where that is, under here it says tools, and you can see where it says custom views. And what I'm going to do, what I did was I created a custom view based on those 10 metrics I just went over with you. Now, if you know the metrics that you're going to want, you can just kind of type it in here. I'll just write in the word profit. And, you can see there's a lot of different profit type metrics. But you can also go in here to this little drop down arrow, and there are many different categories in terms of a lot of these fundamental analysis. Now, for instance, we'll talk about cash flow in a bit, or free cash flow. But see, there's a lot of different metrics that you can use. You look at operating cash flow growth, net cash flow growth. So there's a lot of ways that you can look at metrics that you believe that will help you with your valuation. So I made this, call it my investing custom view. So let's go back to Warren stocks. And so I'm going to come back to this drop down here, and there was where we found the fundamentals we just did. But here's my custom views. I have a lot of them. And here's that value investing. And so they're kind of laid out across the top here. So the first one I want to look at is price to sales. Now remember what the guideline was, 1 to 2. And if we look at Buffett's, again, we do have some outliers. We do see that a majority of the stocks that are in his portfolio fall in that range of just a little bit more than 2 and just a little bit below 1. So I think this is a really good guideline for us in terms of looking at price to sales. Debt to equity, another metrics of safety that Buffett is concerned about. Again, the less debt we have, the more equity, the better. And again, if we look past a few of these outliers, we can see that the debt to equity ratio, remember the guideline was less than 1 is good, that many of his stocks have low debt to equity ratios. Return on investment. Remember the effectiveness use of a company's money, right? How much am I getting back from my earnings? Again, this is more of a comparative analysis for us. But look at the companies that are in Buffett's portfolio and the return on equity that they get. What is the average value? What is the mean value? And you can see that of those that are producing, that are effective, that are making money, we're getting close to an average around 10 or 10%. I think this is a good value as well. Or profit percent, right? That operating margin, the amount of return per unit sales, right? How much sales, every time a sales unit goes up, how much profit is the company going to produce? And again, if we look at this in terms of a spread of profit margin, again, I think we could say that value around 10% is a good value for us to start looking at. And then our enterprise value. Again, how much would that company be worth if we were going to go out and actually buy it? And you can see the formula here takes into consideration short and long-term debt and preferred stocks, and you minus the cash value. It's a little bit of a complicated formula, but the concept is pretty easy to understand. Now, what I process here, again, in terms of value investing, we talked about this comparative analysis. So what I've done is that I've sorted this by investment enterprise value. And notice that we have it pops right up to the top. And I think this is kind of a cool process, which when you start to using these metrics in part of your process would be doing that comparative analysis. Here we see Visa and MasterCard, right? 2 credit card companies. And if we go across the board here, we look at them and do a comparative analysis. First of all, PE ratio. Well, MasterCard has a PE ratio of 34, where Visa has 29. Again, both of them are above 25. So can I justify this PE ratio? Well, do I get enough return on my equity, or is this company creating enough profit growth over the next 3 to 5 years? And you can look over here and you can see, yeah, both of these companies are doing very well on return on equity and profit margins. If I go to my book to sales, both of these in terms of price, in terms of their sales, are above that value that we would like to look for. Now, again, these might have been companies that Buffett bought that have now appreciated. But then again, let's look at debt to equity. So of these two on a comparative basis, debt to equity, Visa, right, has less debt than MasterCard. So MasterCard would have to service that debt, which could take away from some of the potential profits. Dividend yields about the same, relatively. Again, Visa just a little bit better. Earnings, right? Again, think about our PE ratio, right? Our PE ratio of MasterCard is 34. Their earnings is $10. If they earn $10 for the next 3 to 5 years, would that value, consistent value, would that justify a 35% PE ratio? And yes, it does. If Visa earns $7.88 for the next 3 to 5 years without earnings growing, does that justify a 29 price earnings? And that would be, I would say, probably a little bit below that, right? Not much, but a little bit below that. So again, how we can compare individual stocks based on these potential matrices. All right, so that was kind of like how we can go through that process of comparative analysis. So let's do something a little bit fun here. What I'm going to do is, where am I? There I am. Okay. What I did was I took again those 10 matrices and I put them into a screener. And I call this screener a value investing screener, very similar to my custom views. Now, those of you who are interested, at the end of the session, I will show you in our slides. I do have both of these in the slides, so you can look at them. But again, remember, value is what the individual investor thinks is value, and it's going to be different from person to person. But here are those value matrices. And so what I did was just have some fun here for today's session. Let's just kind of play with this. So profit margin. Well, we looked at what Buffett is kind of telling us, and we determined that, let's assume we want to get a profit margin of about 10%. PE ratio. Again, I want to be on the low side, let's say below a 20 PE ratio. So I picked low. Debt to equity. We said that our guideline here, debt to equity, was somewhere between 0 and 1. Annual dividend yield. And again, not all companies pay dividends. And I don't want to make this dividend yield a super high yield, but let's make it a little bit of a bar to jump over. Here I'm using a 1.5% yield. I don't think that is too much to ask a healthy company to pay. And notice that earnings per share, I don't have a valuation. Net cash flow, I don't have a valuation. Price to sales. Again, we wanted to be in that 1 to 2. So I've used a little bit wider range. And then again, that return on equity. Again, that value, we said about 10%. And so now what I've done is I took all these matrices, I put in values that I determine are what I would determine to be value matrices. And then up here, we do have the different exchanges of all the different markets. So let's just do this. Let's just go through, for instance, let's just look at the NYSE or the New York Stock Exchange, and let's sort on these. And what do we get? Well, we get 74 choices out of, like, I don't know, what is it? There's 500 or 600 stocks on the New York Stock Exchange. And you could go through this. And again, let's go to our filter views. These are all the matrices that I used in that set filters. And, you get a wider range here. Insurance companies, agriculture companies, a lot of banks, I notice, coal companies, retail, transportation. Again, now at this point, as we can start thinking about a value investors, are these companies unique? Do they have a unique property? Do they have a distinctive advantage? But, again, remember I just said that earnings per share was not a valuation, right? I'll go back to the filter here, right? Earnings per share. We didn't pick a filter on this. And yet when we sort these companies by those few metrics that I used, that I did put values, notice that the earnings per share for a lot of these companies, right, is above $10, right? Okay. Again, justifying, let's say, maybe their PE ratios, justifying their PE ratios. So this is a great way how to use the valuations to look for particular stocks. And then at this point, then you could say, oh, which one of these ones would make more sense to me? Which ones of these would be value companies? Again, I could also look at, my PE ratios. Again, look at the PE ratios here are all the ones that were below 20. And then how are these companies managing the money that they're making? How much are they returning on their capital and their equity? And you can see that a lot of these companies, based on these metrics, have really good return on equity. All right, so that's the stock exchange and the New York Stock Exchange. Let's do NASDAQ, right? There's a NASDAQ, much larger basket and a much larger ocean to fish in. And, I get even less. I get 56. Again, I think when we look at the filter view here, you're going to see a lot of banks. And that might be the way that I've set up the value metrics, right? But, let's look at a few of these. What the one that I saw this morning that I thought was a unique company. Let me do this. Sort this. Yeah, Smith and Wesson, right? I mean, you talking about a unique product, right? And maybe, having brand loyalty. Now, again, it just depends on how you look at the idea of guns, or, what could happen with gun restrictions in the futures. But I'm just pointing out to the fact that, here is a very unique brand that produces a very unique product. And I'm sure the gun holders will tell you that this is probably one of the brands that they look at. But again, doing that process of looking at price to sales, or PE ratios, and our return on equity, this does look like a very, very healthy company. All right. So just for fun here, I just wanted to show you this. Here's our webinar we did at the beginning of the year. This is our 23 stocks for 23. And I basically went about and used some of the philosophies that Buffett used, and I basically built this portfolio based on a defensive. Wanted to be a little more defensive this year, and I looked at a lot of the same metrics as I just showed you. And what I want to kind of show you here is, in terms of what we just learned from Buffett and those value metrics, for instance, here's price to sales. Notice, like in my portfolio, a lot of them fit right in that 1 to 2 category. Our debt to equity, again, less debt is good, and you can see a lot of my companies that are in this portfolio have a low debt to equity ratio. Dividend yields, and that is definitely one of the criteria that I used in selecting these stocks. I wanted to make sure that most of these companies have some type of dividend yield. And then looking at our price to earnings versus our return on equity, or our percent of profit. Can I justify the price earnings ratio versus the return on equity in the profit percentage? And notice that any of these stocks in this portfolio have a PE ratio below that 25-20 threshold. Again, I didn't sort these based on a filter like I showed you on the screener. These are just companies that I use basic valuations that would determine what I would consider a value company. All right. So let's go to one more final piece before we finish up today. And this is going to talk about intrinsic value. And this is one of the things that Buffett and Charlie Munger look at. Now, the concept is basically pretty simple, but the formula is quite complex. So I don't have the time and or the expertise to go into details about this, but I want to just give you some main ideas in terms of how Buffett and Charlie Munger look at what is called intrinsic value. So what they do is they look at something called the discount cash flow analysis. And what they want to do is they want to value the estimated future cash flows and then discount those cash flows to try to figure out what the asset is worth today based on how much they're going to produce in the future. Now, Buffett and Munger talk about using a 10-year timeline. Now, they'll take those cash flows and outflows and they'll discount them based on an appropriate interest rate. Now, in the past years, Buffett said it's been easier for them to do a lot of this discounting because, interest rates have been relatively stable. But this is where it's going to become a little bit more complicated, moving forward. But then what they look at is that expected interest rate over, let's say, this timeline horizon over the next 10 years. And then they look at how much cash that business will make in the future and what would those cash values be worth today. Similar to like with a bond in the bond market where you have what is called the net present value, right? If you sold a bond that matures 30 years from now, how much is it really worth today? And this is where Buffett talks about, again, this margin of safety. So the difference between the intrinsic value and the market price. Is the market pricing or is underpricing this intrinsic value? Now, in terms of margin of safety, Buffett usually will say something to the fact that, if this company has consistent returns on equity, consistent earnings, then their margin of safety might be a little bit less, maybe 10% or 20%. If it was a younger company who, in the past few years, maybe their earnings are a little bit sporadic, then they would require a greater margin of safety, let's say 20 or 30%. And again, this valuation is unique to each individual investor, and certainly Munger and Buffett have their own style. So the point here is that, the idea of intrinsic value, this discounting of cash flow and putting it on a net present value, it's pretty easy idea to understand. But the formula is very, very difficult or complex. Now, for those of you who have a UBS account or you have access to a UBS information, they just recently put out a investors report based on this discount cash flow analysis. And just to tell you how complex this is, that report was 36 pages. So it is a bit complicated. But what I tried to do for you today was show you some of those basic valuations and how you can apply them to help you determine what you consider is a valued company. All right. So I do see a couple questions. Let me answer a couple questions before we finish up today. So the question here is about why do analysts use price to sales ratio? Wouldn't enterprise value of sales be more realistic or screen out companies with too much massive debt? I think that's a great question. I think that is a good answer. But I think going back to the price to sales ratio, why analysts like that valuation is because, let's be honest, when we talk about quarterly reports or, these earnings reports, they can play some accounting tricks, let's just say, to earnings and debt and all those other little pieces of information. But sales, they can't, right? Those are raw numbers, right? So I think why analysts like the sales to price ratio is because they can't really do those accounting tricks to sales as they can to some of these others like earnings and debt. And so I think that's your answer, Jeffrey. Okay. Any other questions, Gene, before we tie this bow on this little project today?
Well, I've had a number of people asking specific questions, and if you can, go ahead and email support@barchart.com if I wasn't able to answer your question fully. John's just going over some ideas and different metrics and how to possibly apply them to finding decent trading candidates on the website.
Okay. Thanks, Gene. All right, so let's do this. So what are some takeaways from today's session? Well, Warren Buffett's value investing style emphasizes the importance of thorough research, right, analysis, and long-term perspective. I can't emphasize that more. That his philosophy is really if you can't hold I think he says something like if you can't hold a position for more than 10 minutes, then you can't hold one for 10 years. So he's really about this long-term process. Involves seeking out undervalued companies with strong fundamentals, right? Those price to sales, those earnings per share, return on equity, profit margins, and thinking about that distinctiveness, that story that the company is telling us. Does that company have a comparative advantage, right? And we looked at some metrics that help us avoid what we would consider overpriced, right? You look at some of those price to whatever metrics is, right? And how we can define if that price to earnings or PE ratio, price to earnings PE ratio, is worth that valuation, and stay away from those risky investments. Successful value investing requires patience, discipline, and a duty to continuously learn, right? Learning, I don't claim to have all the answers, right? I'm always learning things, improving ourselves, not only in terms of our selection process, but, the knowledge that I'm going to gain from seeking out the advice or the habits of other successful traders, and that commitment to do that research, right? That patience, that take our time to make sure that we find those good candidates. We're not just going to jump into every trade that we find. Remember, we're only going to limit ourselves, according to Buffett, to 20 picks. And then, if we do our due diligence, the rewards can be substantial over time for those who are willing to do the work. Okay. So here's on the slides, here's that custom view. And here is that screener that I showed you. And again, it just depends on what you want to screen on. So let's do this, Gene. So next week, we're actually off. So it is President's Week, and we're going to take a week off to do some planning for our March webinars. And I will let you know that in the 1st of March, in 2 weeks, we're going to do a webinar called Anchored Volume Weighted Average Price. It's a new feature that's on our bar chart. One of the things that kind of Gene was mentioning in the beginning about we've been busy adding some new features, and this is one of the new features we have. And so what I'm going to do is I'm going to give you my interpretation for our swing traders, how you can use the VWAP indicator, but also I'm going to go back in history and show you how this VWAP was created and what was its original intention and how it's evolved, in trading over the last few years. So I think that'll be an interesting webinar for us. I want to remind all my Premier members that On Fridays, we have our market and close, and you don't need to download any program or software. You can just go right to our market and close page, and you can access that through our website here. Again, all of our sessions are archived, and sessions will end up on our YouTube channel. And if you're watching on YouTube, I'd appreciate a thumbs up and give me a little comment what you liked about today's session. You can find those on the YouTube page. All right, Gene, did I forget anything?
No, John, I think we're all caught up.
All right, great. Until next time, folks, be safe, be healthy, and the good of all trading.